Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The market has sold off some really incredible companies recently, and there are three that I think are amazing buys right now. That's what I want to get into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM. I have a link to that in the show notes, and there's a link below on the screen. I'm going to get right to it. The first stock that I want to go over is Airbnb. As I'm recording, Airbnb has a $78 billion market cap, $2.3 billion in total debt, and cash of $10.3 billion on the balance sheet. So an enterprise value of about $70 billion. But look at these numbers. This is the most recent quarter. So we don't have third quarter results yet as I'm recording, but revenue was up 18% last quarter to $2.5 billion. Net income, $650 million. And this is the biggest thing right here, $900 million in free cash flow in the most recent quarter, up 13% year over year. And for the last 12 months, $3.9 billion in free cash flow. So you have a business that's growing really quickly. It has a great balance sheet and is generating a ton of cash. Now, management has a lot of options for what to do with that cash. Do they want to reinvest it in the business? Do they want to acquire potential competitors? Do they want to buy back stock, pay a dividend? In a market like this where there's a lot of uncertainty, there's a lot of companies that have negative cash flow that are just getting crushed by the market. Being a cash-rich company gives Airbnb a ton of flexibility, and I love that going forward. So this isn't a cheap stock. The enterprise value to free cash flow multiple is about 18 right now. So that's not extremely cheap, but I think you're getting an incredibly high quality company, a company that can grow steadily over the next decade for that price. So that's why I love this stock. One of the things I want to hear over the next quarter, especially in the next quarterly earnings report, is what they're going to grow into. Management has talked about growing beyond the core a bunch of times in the past. There's a lot of things that they could do, experiences, add local services so that when you show up at an Airbnb, maybe your fridge is stocked. There's all kinds of services that they can add to their core that wouldn't be all that expensive from an operating expense standpoint and would be incremental margin. But let's see what management talks about in the future and see what those numbers are. But right now, given the current price, I love Airbnb stock. The second stock is MGM Resorts. This is an entertainment company primarily located in Las Vegas, although they have regional casinos and then 2 casinos in Macau. What we have seen in Las Vegas over the last few years is just a massive recovery since before the pandemic. Record gambling revenue on the Las Vegas Strip. That has pulled back slightly over the last couple of quarters, but still just tremendous cash flow coming out of those resorts. And remember that MGM Resorts sold most of their real estate to a number of different REITs over the last few years, so got very good prices for those assets. And now they're just paying rent. So I'm gonna show a little highlight of the company's most recent quarterly report, but this is really a cash flow business, and that's what you want to see, just generating cash year after year. And then likely the best use of that cash is buying back stock, which they've been doing pretty regularly as well. This is a look at the metrics from Las Vegas. You can see here adjusted property EBITDA. This is earnings before interest, taxes, depreciation, and rent. I'm going to talk about rent here in a second, but $777 million, just a tremendous amount of cash coming out of these resorts. Move down to the regional resorts, $294 million. I'm going to add these together and get the run rate. If you add these two together and just get a run rate on an annual basis of $4.3 billion of adjusted property EBITDA, subtract about $1.7 billion worth of rent payment that they owe every year, and you get $2.6 billion in cash coming from US resorts. Just a tremendous amount of cash. And remember, this is a company that has a market cap of $12.5 billion. So could buy back a lot of stock with that amount of cash. And that's not all they have going on. MGM China continues to recover $209 million in adjusted property EBITDA last quarter. There's likely a lot of upside from there. I think these resorts could generate between 1 and 1.5 billion cash flow per year. A lot of that cash ends up coming back to the mothership. They own a little bit over half of these resorts, and they get a steady dividend from them. So the one thing I'll add, this is the rent payment that I talked about earlier, 2023, $1.7 billion in total cash rent that they owe for most of their US properties. So that's where some of their cash flow is going. But the general trend for MGM Resorts is that people are spending more and more money to go to destinations to meet up with friends, family, coworkers. A lot of the remote work really means that we need to meet up in certain places. It means that we may need to meet up in centralized locations. What a better place than Las Vegas or Macau if you're in Asia? I think these are going to be massive tailwinds behind these regions. And remember that MGM Resorts is relatively cheap right now. $12.5 billion market cap. I talked about the cash flow coming from the US and from Macau. So, about $3.5 billion in cash flow coming from the business. They could buy back a massive amount of their stock, which they have done over the last few years. I think that will drive shares higher. And this is just an overlooked stock in the market right now. The final company is Spotify. This is the music company and audio company, has about a $29 billion market cap. So, very big company. But the momentum that they have in their business right now is just phenomenal. This is the summary from their most recent earnings report and a couple of things that investors should keep in mind and watch for next quarter and watch for with third quarter results, which are going to be out on Tuesday. Total monthly active users up 27% year over year last quarter to 551 million. They are on their way to a billion monthly active users. There's only a handful of companies in the world that can say that. Premium subscribers 220 million, again up 17%. But this is really where the upside lies with Spotify is these 343 million ad supported monthly active users. Now, they're not generating a ton of ad revenue, $404 million in ad revenue last quarter, but this is really where the company can leverage its technology platform and its place in the market to become a huge ad platform. I think we have seen recently, not only are they experimenting with artificial intelligence advertisements, so ads that are read by celebrities, but maybe are for your local auto dealer or furniture store, but also they can serve those ads on a more localized and targeted basis. A couple of things that I'm watching in this upcoming quarter. Do their cost cuts start to really take hold? They've been cutting costs all year, but it takes a while for that to flow through the system. So, do gross margins and operating margins improve? I think that would be a great sign. I'd like to see these operating margins go to positive. It technically is a free cash flow positive company, but that's because they're pulling out stock-based compensation. I think right now there's just a lot to like with the momentum in Spotify's business. They haven't monetized it extremely well yet, but what you want to get is those active users first, and then you can start to monetize the business. That'll likely take a few years, but that's why there's significant upside in the stock going forward. So there's three stocks that I went over today that I really like: Airbnb, MGM Resorts, and Spotify. What do you think of those three? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.